Thank you, Sophia. We're very lucky to have Sophia as an advisor to the DarcMatter team. Thank you, Shashank and ConVista team for hosting us here. We did fly from New York. We're on a road tour, if you will, for our ICO as well as our company. Spending some time in tropic zones, winter storms, German weather. So it's been very, very exciting. By show of hands, who here is a crypto owner? Okay. Who here is a blockchain enthusiast? If you will. And who here is thinking about an ICO or involved with an ICO? Okay, I'm just trying to get a sense of the lay of the land. Feel free to stop me at any time if you want to talk about something, if you have any questions. We'll keep it kind of informal. And of course, at the end, we'll also open up for any questions or anything you guys want to talk about. So my name is Sang Lee, and I'm the CEO and co-founder of DarcMatter. We're a US-based global fintech platform focusing on the alternative asset class. We've been around for about 3.5 years. And I'll talk a little bit more about what our company actually does. But since this is blockchain training, one of the things that I wanted to talk about is the state of financial services today as we view it, the kind of the new opportunities that blockchain does bring, and probably a lot of what the current industry faces in terms of its own challenges and frictions. It wouldn't be a great presentation without a lot of disclaimers, so read it if you like. Like I mentioned before, our background is the leading end-to-end solution for GPs and LPs. So we focus on the fund asset class for alternative investments. So alternative investments as a whole is very, very broad, but we'll kind of specify it because anything that's not stocks, bonds, or cash is considered an alternative investment. Asset management globally, around in 2015, so it's closer to about 75 trillion today, but it's about $71.4 trillion. However, by 2020, we estimate that investor wealth will grow to 224 trillion, which means about 140 trillion is not currently actively managed. Most of that is actually coming from Asia Pacific, which is why there's a problem with asset management and access to new financial products. Alternative assets, more and more investors are allocating away from stocks, bonds, and cash because of various different reasons, including correlation and new portfolio theory, that the traditional model of 60-40 doesn't work anymore. So based on this trend, by 2020, we estimate that the total global alternative investment asset class will be about 15.3 trillion. That's conservative because that was as of 2 years ago. Currently, we're estimating it's actually going to be closer to $20 trillion. So this is kind of the chart. I'm assuming a lot of folks do have some financial services background, but I'll do a quick run through. Like I said before, traditional investments is everything that's stocks, bonds, or cash. We call it traditional investments because you can actively access it, and it's highly liquid, and you can get in and out almost instantaneously. Then there's things like tangible investments, but this is mostly for institutional investors. You buy timberland, you buy real estate, you buy big commercial buildings for investment purposes. And then there's the other alternatives, which is art, whiskey, wine, things that people like to buy and apparently they appreciate. People buy sneakers too. So there's a lot of different things that people are investing in. And now we're gonna throw like crypto in there, right? So we can throw crypto into a lot of these buckets, but we'll probably throw it into the other investment bucket. And then now we talk about the core alternative investments. So this is where we operate. This is the biggest subsector of all alternative investments: hedge funds, private equity funds, venture capital. So this is 3 largest buckets that characterize what we call private managed funds. So everything that's not a mutual fund or an ETF. And then you have other kind of subsets of these two, which are private equity infrastructure, real estate, et cetera, et cetera. But once again, this is primarily for institutional investors that have an investment horizon that's looking between 30 and 40 years. But alternative funds as a asset class, it's not that well understood even now unless you're an active investor. So it's very, very hard to access. There's not that much visibility. So I'm going to do a quick run through of each of these fund asset classes, just assuming that most folks aren't invested into these yet. So hedge funds are by far the largest asset class for alternative funds. They characterize about 67 to 72% in any given year of all managed money. Primary reason being they're liquid. So what that means is they invest in the traditional asset classes that we talked about, stocks, bonds, and cash, but they have a specific strategy that manages risk or sometimes increases their risk so that they can enhance their returns. They're also what we something called open-ended. So it means I can go in at any time and I can leave at any time, barring the lockup provisions. But it also has what we call less of an illiquidity premium. So the return that you get for investing in something that's very, very private is much less for hedge funds because they have to buy in the open market to redeem certain positions. And then the two that we know more broadly, venture capital. So technically venture capital is a subsector of private equity. The only difference being venture capital doesn't leverage itself. Private equity is what we traditionally, Blackstone, KKR, these mega funds, they go in and buy buildings or companies, take companies private, then flip them after they fix them. Both of these are much more illiquid than hedge funds. So they have a much longer horizon. One is earlier stage, one is later stage. Very, very long lockups. So fund life is typically between anywhere from 7 to 10 years with a very, very limited secondary market. And we're going to talk about why that's an actual problem. So I've done a very, very high level characteristic of alternative funds. And already there's so many subcategories that aren't well understood and actually keep it from becoming accessible by most investors. So two things. You don't have to be a fund that operates in the that is domiciled in the United States, but if you take a single dollar of US investor money, now you start having to classify into two separate types of funds. As an example, 3C1 is an accredited investor fund, that's what we call that. You can have only 99 people in that pool. And then 3C7 is what we call a QP fund. So if you have more than $5 million, we call you a qualified purchaser. You can have unlimited numbers of investors there. Who the hell knows these distinctions? I mean, until you actually deep dive into the separations and the documentation, there's actually no way of telling what's what. And then we add another layer of complexity, including the EU as well as the United States, with huge jurisdictional issues with this asset class. Stocks, they're well understood. US, we have ADRs. You can buy Apple somehow, even if you live in a different country. In this asset class, there's almost no way of accessing a fund that is not domiciled within the area that you live, for various different reasons. So I talked about some of the big problems, but now I'll just go into more of the macro of what the alternative fund is facing. So this is renowned for having a lack of transparency. There are times that a fund manager actually tells the investor they won't give them their financials. And it's well accepted that they will not actually give them their financials or their strategy. And that happens in private equity because of privacy issues. But what ended up happening is it increases third-party fees. So you have to use a lot of intermediaries to be able to check information now because you can't directly access that information. All interactions over the last 20 to 30 years have happened offline. There was no online marketplace. There is no online accessibility for these types of products. Either your financial advisor knows somebody or your best friend is a billionaire and he introduces you to a fund that says, okay, I'll accept your money. I'll do you a favor and I'll take your money, right? The third is what I mentioned before, which is the complex and evolving state of regulations. EU continuously puts out new regulations to protect investors. US is continuously evolving its regulations as well. And then now we throw in what I said before is the biggest market for wealth management, which is Asia. And Asia doesn't have a well-developed regime for financial regulation yet, which means nobody quite understands how this is going to affect the space, even though they expect growth. So how do you grow when you have so many friction points without technology and without efficiency? And then the fourth, which is tied to the complex global regulations, is the increasing cost of compliance. So every country wants funds to be more compliant, they want them to be more transparent. They want them to fix these situations. However, as you know in financial services, it's a margin business. So you can't increase your price of your product anymore. So if you're a hedge fund that charges 2 and 20, because my lawyer fee goes up, it doesn't go up to 3 and 30, I just make less money. Which means I have to figure out a way to control my costs, but also increase transparency for my investors, but also for government. So now I gave the kind of summary of alternative funds and alternative investments in pretty granular detail. But before I go into the efficacy of a blockchain or why would we use a blockchain for financial services, I think there's two, I guess, high-level ideas that are actually very, very important when you think about blockchain and decentralization and what that actually means. There are two types of primary businesses or industries that form. They're pipeline industries and platform industries. Pipeline industries are literally what it sounds like. I have a huge sales pipeline, and all I have to do is sell into that pipeline as fast as I can. And then a platform business is much more like a marketplace. I need the two parties to interact with each other directly, and I end up as either as an intermediary or what we call these days as a re-intermediary. You disintermediate and then you create a new entity that's more efficient and much bigger and able to scale. Most businesses tend to be pipeline, traditionally speaking, because we didn't have technology 20, 30 years ago to scale up. You just had a huge sales force that called people, and you were able to sell anything, whether it's a sock or whether it's a stock, right? You can sell anything when you have a big enough sales team, and you can scale that up indefinitely when you have no cost on the bottom. So that emphasizes, like I said before, the sales cycle and what we also call information supremacy. It means I have the customers and I have the Rolodex. So if I know the most people and I know where they are and how they behave, then I'm the winner in that market, at least for the foreseeable future. Platform is the complete opposite of a pipeline business. I have to scale because my margins are tiny, they're very, very small. I have to scale and I have to rely on a network effect. And the network effect, as many of you know, is one person brings in 3 potential customers, and then 3 brings in 12, and then 12 brings in 100. So I need that to happen through a virtuous cycle where people find benefit on both sides, whether I'm a buyer or seller. Financial services is the most important pipeline business. So the number one reason that pipeline businesses self-form, even though a platform business is probably better in the beginning, is that regulatory pressures usually create pipeline businesses. So if you think about healthcare, if you think about financial services, anything that has a heavy element of regulation from the government tends to become a pipeline business because you can't spread out the information that you're actually gathering during that time. So you have to focus on the client that you have for a very long time and ensure that that client stays with you. The other thing that actually occurs is that since you can't scale up, you create a lot of manual processes that follow the pipeline straight through, and then you have to have that manual process come straight back. What that does, though, is that it creates pressure when your sales cycle has to increase further down. So it becomes more expensive for the paperwork at the top to get to the bottom as you add more layers for the sales cycle. Then you also have to rely on information arbitrage, right? So you have to know more than your competitor in order to survive in that market. And you have to rely on that asymmetry in order to survive in that market as well. Like I said before, there's also pressures on high regulation and compliance costs because it tends to be an incumbency business as well. And then the fourth thing, which we found to be very interesting, but it's something that's actually evolved as a thought through blockchain because of what actually can happen with blockchain, is financial services poses great systematic risk. And what I mean by that is you can implement blockchain, you can do whatever you want. But what happens when that system fails? As an example, let's say we use the Ethereum chain ERC20 to build all of these ICOs and you have 1,000 businesses. What if the Ethereum network fails? What happens to all of the ERC20 contracts? Who's responsible for these things? So in financial services, it's important that it takes a bit of a long time. There's a big lead time and there's a lot more brains that need to get involved to ensure that we can take care of the systematic risk and what we also call a pinpoint risk, things that we can't see today. So I think I talked about all of this. There's a couple of things that I probably didn't mention. So with pipeline industries, it doesn't scale. You actually physically cannot scale because your incremental cost goes up as opposed to decreasing. And at critical mass, like I mentioned before, the margins actually stay the same, but your costs keep increasing from the bottom up. Human error and information asymmetry tends to become the primary problems for these things. And it's not inclusive, so you can't fuse market dynamics of supply, demand, and good behavior and game theory when you have a pipeline business, because I'm the only one that's actually responsible for that pipeline. Consumers tend to be left in the dark, and then, like I said before, you have massive systematic risk that you need to fix. So, but why blockchain, right? Like, why blockchain and financial services? And the reason I talked about pipeline versus platform is because blockchain fixes a lot of the elements of platform building that we've been facing today. So DarcMatter as a business is a platform business. But however, we're a centralized platform. What that means is DarcMatter is responsible for the database upkeep, for the information security, and we still have to incentivize both sides to interact and invest in one another. In a blockchain system, you can actually create game theory-driven accountability, where people enhance the overall security and transparency of the system without somebody like DarcMatter directly in between and forcing them to engage in that behavior. And then the second element of that is that the risk of human error is drastically decreased, right? There's a couple of different projects that work on arbitration, for example. Their big project is arbitration. The risk of human error and one person saying, well, I think this is right or wrong, is decreased as you spread that risk out into the network. And then the other thing for financial services, which is very interesting, is the transferability and discrete value parcels. And so what I mean by that is right now, the discrete value parcel for a hedge fund is this document that says there's a cap table of 20 people, right? It's literally a document that's printed out on Excel that says his name, his address, how much he has. That's not a discrete value parcel. I can't sell it. That's really, really hard for me to sell. Actually, it's impossible sometimes because the contract reads you cannot sell it. And the reason most funds don't want to sell it is because they can't, in a secure way, keep their private information private from the rest of the world, except to that investor. Tokenizing a system and putting it on the blockchain actually allows you to do that. And so in an industry where the transference of value, and we talk about that a lot with Bitcoin, but with financial instruments, the discrete value parcels are going to be a huge movement for all of financial services, because transferability, information security, without error, without intermediaries, is going to be the biggest, I think, change that we can see through blockchain for financial services. So now I'll just talk about what we actually do and like why this matters to us. Like I said before, we're a platform that connects fund managers and investors. We have LPs from about 24 countries, 1,600 LPs. We work with about 150 funds, the majority of them being in the United States. So the workflow platform that we currently run is basically automating the process between identifying a new opportunity and then being able to invest in it. So we talk a lot about AML, KYC, and blockchain. In reality, that's been done for about 20 years, and there's like technology tools to do it. However, they're not decentralized. They're not decentralized solutions that you can store forever in an immutable fashion. It's a very centralized solution, so our system has to run AML, KYC on an investor before they can access anything in our system. But all of these tools are basically going to be shifted into the blockchain. We do smart matching of LPs and GPs, so we use AI and machine learning to track behavior for investors, track behavior of fund managers to be able to match them in a smarter fashion. What we really like about that right now is we have to collect the data individually from investors and fund managers. Once you actually shift it into the blockchain in an anonymous fashion, I can actually get a snapshot of the whole fund industry. But I don't know who's that investor, I don't know who that fund manager is, but I can tell that 26% of German LPs want to invest in fixed income hedge funds instantaneously, without having to do research and things like that. Automating all of the workflow and paperwork. So right now, we still use the documents that the fund managers have. They still need their KYC AML document. They need their subscription docs. They need to use capital calls. We automate that system, but we are still limited by the fact that it's not a smart contract. It's still a manual contract, and the reason we didn't take the first step of tokenizing the asset class is they don't understand blockchain yet. So trying to leapfrog that quickly, and we've dealt with this industry for years now, is going to be very difficult. The best thing actually for our user base is to automate all of the contractual flow and then switching to a smart asset is much easier for them to absorb. Because if you think about it, I'm a very sophisticated LP, for example, and I have a huge team. It's going to be very hard for me to go in and get approval to buy a token which purportedly holds the value of a venture capital fund, as an example. But they will understand why the contracts and why the blockchain will make their life better. And we're actually the only platform that provides cross-border investment flow. So we have an office in New York, Shanghai, Hong Kong, and Korea to be able to connect this new massive wealth opportunity to the asset management industry as a whole. I mentioned kind of our offices. These are some of the top firms that are using our platform, whether they're financial advisors or wealth managers or family offices all over the world that are using it to identify new fund opportunities. Some of the awards that we've won through the years in financial services, but also in startup. This is kind of a snapshot of what we're currently working on, a little bit dated, but about 1,600 LPs now, on average about $1 million per LP, because we have a lot of financial advisors in the United States. Most of our international clients are institutions. So this is kind of a snapshot of our blockchain on what we're working on. So we use the NEM blockchain for our upgrade, if you will. NEM is a Asia Pacific based company that's developed a top 10 blockchain. They exclusively focus on financial services. They've had a dedicated team that didn't focus on the hype or the marketing. They really focus on the core tech. They're very modular, which we really like, so you don't have to build things from scratch. But we are going to be using this as a permission blockchain for our system. Kind of how it works, I don't know how much deep dive you want to do into the tech, but basically the front end of our system still remains the same because I, as a fund manager and investor, don't interact with the blockchain. I need a site that I have to interact with. This is the system that actually stores all of the smart contracts. And then the singularity nodes are basically what we call super nodes or master nodes. Because it's a permission blockchain, we don't have outsiders mining or verifying the transactions. They have to be an insider, so you prevent manipulation of the pricing and the underlying token. And all of these are kind of third parties that you see in the industry today, right? Escrow, administration, verification, and we can have that trigger instantaneously through our APIs. So that's it for now. Our contact information, Sophia is based in Germany, and yeah, if you're interested, definitely reach out if you have any questions. Oh, I'm happy to take questions now too.